Hi, everybody. This is Tim from Trading Strategy Guides. Hope you guys are having a great day. It's morning here in Texas. Today, I'm going to show you a great strategy using the Trader's Dynamic Index. I'll get to that shortly, but first, let me cover a couple of other things. First thing, I want to make sure that you guys can hear me and see the slide. Of course, if you can't hear me, you don't know to answer that question, but if you can hear me, please let me know. Just so you know, the coffee is good this morning, but I guess it's good every morning by definition, right? It's got to be pretty bad not to be good. Okay, while I'm waiting for some responses from you guys, I want to remind you, if you're watching this recording, watching the recording of this live webinar, you can speed it up by clicking on the gear icon in the lower right and selecting a faster speed. Of course, those of you who are listening live get the benefit of my sparkling personality. No responses from anybody. You guys have to tell me if you can hear me. If you can't hear me, we might have a problem. Next thing I want to do is apologize in advance, but once again, we're having pretty severe thunderstorms here in Northeast Texas, and the heavy rain can get pretty loud in my office here. So if you hear a bunch of noise, I have a pretty nice directional mic here, but if you can, if you hear a bunch of noise in the background, you'll know it is heavy rain. Thanks guys. Appreciate the response. Also, I want you to stay around to the end, and I'll be sharing Trading Maxim number 35 today. Also, don't forget to hit the subscribe button down below and click the bell for notifications. Okay, lots of stuff has happened this week with my open positions that I need to share with you guys. So give me a second here while I get some charts up to look at. Bitcoin's been crazy, hasn't it? Broke above the channel here yesterday, but it did not close up there. So, but the move was supported on big volume. Not huge volume, but you know, greater than average volume. So that's a pretty good sign. You know, May 3rd, I mentioned that I took half off of this Bitcoin position. Let's see, that I got in back here at in April. So I took half of it off right here on the 3rd for $296. Still have a small piece. I only took a small position on this because it was because I really think this isn't pulling back. So it's a pretty strong move, but it could decide to pull back at any moment. So I didn't get too crazy on my position here, but I didn't get stopped out down here, and I got it hit the ATR up here, and I took half of it off. So I'm still holding this other half with my stop loss just above break even. This small piece is up a few $100s now. Let's see, it's up to 5,800. I was in at 54.42 right here, so that's pretty good. If this breaks above this channel, I think we'll have a situation known as a bump and run. A bump and run happens when the chart is in a trend and then suddenly the trend gets steeper. So it's usually considered a bad sign because the price action ends up burning itself out. If that happens, I'm going to be more aggressively following my stops. In fact, I'll consider moving my stop up just below this level right here after we get done with the webinar. Okay, the next thing to look at is crude. This crude has kind of followed my script right along. This was wedge, broke out of this wedge. It went down a whole lot more than I wanted it to, but I waited for this close, and I entered short right here. Barely eked out without getting stopped out right here. It came like within a cent of my stop out, right? My stop loss up here. But I did not get stopped out, and I got my first target on this candle right here. So I got half of it off for $1.31. I have the second half running at break even currently, and as of last night, it was up 65 cents. I think it's a little bit smaller now because of this jump this morning. So I've got a couple of videos that I talked about crude in, and I'll post links to both of those below. One of them was on April 15th when I was talking about looking for the break of this. Let's see, April 15th would have been right in here. And I was talking about this bearish wedge. And then after it broke on the 29th, I talked about it too. So I'll post those links below. The next thing is Boeing. Monday, I mentioned that Boeing was approaching the bottom of this descending triangle. Well, it got a close yesterday on nice, more than average volume. I wouldn't call this huge, but it's higher than average. So I'm good with that. I sold this around 357.23 right here, and I don't think it's too late to get in this. It's right at the spot where I entered it. It's close. In fact, it's a little better position than I got in. So this thing has had an ATR of 82 cents. So my stop loss is $1.23 on it. I'm sorry. I was looking at the wrong thing. The ATR is $8.42. So my stop loss is $12.63. Okay. Halliburton is what I was looking at. Halliburton also broke below this trading range. I talked about this Monday that I missed the channel break, which was up in here. And it's moved down nicely from the channel break that I talked about. So Monday, this was just an example of me losing focus, which I do sometimes. Just so you know, we all do it. If you miss something, it's not a huge deal. I did identify that there was this nice trading range happening. So I looked for a close on the trading range, which we got yesterday. So I'm short at about 26.94, and ATR here is 82 cents. So my stop loss is $1.23. So, but if I get a close back in this range, I'll take my close. That's how I keep my stops a little bit smaller with trading ranges. And the last thing I'll look at is Kohl's. Remember, I mentioned that Kohl's was getting a touch from Amazon because they're going to start taking Amazon returns, and that's what this huge gap up here was a couple of weeks ago. But looking at the chart, it did not break any real significant technical levels. And so I really thought it was still in this bearish wedge, and it looks like this is bearing me out right now. There was not huge volume right here on this close below, but I got short right here at around 69.22, and it hit my original target of 67.10 right yesterday. And so I've got half of it off for $2.10, and half of it's still running, currently at break even. So all of this it's doing on below average volume. So I really only took a small position because I didn't get volume support. Whenever I see a break of a technical level like this, and when I say break, I mean a daily close below or above a technical level, I If it's not supported by volume, I will take a tiny piece, but I won't go all in unless I've got volume support. And when I say all in, I'm not shoving my whole pile of gold into the middle of the table. That means I only go full risk, which is 2% of my account. So, okay. All right, let's get on to this TDI now. Okay, this Traders Dynamic Index. It looks like my slide doesn't want to load here, but this is preliminary anyway. I said this a couple of weeks ago, and I didn't say it last week because our strategy was a price action strategy. But this week, it's not a price action strategy, so I'm going to repeat this verbatim. Let me start by saying saving someone some time here. Yes, these are indicators. Yes, indicators are lagging. Yes, everything we look at, including candles, is lagging. It's all historical data. Invariably, someone has to write a comment that says that indicators are lagging. You're right, save your time and don't tell us all of that. If you don't like indicators, don't use them. One of my main points about trading is you have to do you. Whatever works for you is best. That's why there are so many different trading strategies. Okay, let's talk about the Traders Dynamic Index. If I can get my slide up here. Well, you know, it's always something, right? Give me just a second here, folks. We'll get this problem straightened out. Okay. There you go. This is the Traders Dynamic Index right here. I call it TDI. We all call it TDI for short. This is the indicator. It's a 3-in-1 indicator that shows trend, direction, momentum, and market volatility all in one. It's kind of nice. It has five lines essentially. Okay. The green line here, this one is similar to an RSI and represents the market sentiment. So in other words, if it's going up, traders are thinking long, and if it's going down, traders are thinking short. Okay. Shows you how the market is moving related to positive and negative expectation. The red line is just simply a signal line. Okay, so it's a shorter moving average. The yellow line here is the overall market sentiment, which would be an even slower moving average. Shows the overall direction of the market. It has two things. It turns slowly or can continue to go in the initial direction. So because it's a slow moving average, it takes time to turn. So again, it gives us another signal reference. Okay. Then here's my favorite part of this. It's the blue lines up here. They're kind of like Bollinger Bands. They represent the volatility. And you know that volatility is one of my favorite indicators of what where the market is going, what the market is doing, and so on. So having volatility to look at is always nice. These are kind of like Bollinger Bands. The wider they are, the more volatile the market is, or the bigger the candles. So you see here, some of the candles got bigger, so the market got wider, or the TDI volatility bands got wider. Okay. So the strategy rules seem complex because there are quite a few of them, but they're really not that bad. First thing you do is you look for the red line, and I'm gonna show these individually. I just want you to get an idea of what we're doing. We're gonna look for the red line to break above the yellow line. And this, again, is for a long trade or a buy trade. Look for the red line to break above the yellow line, then look for the green line to also break above the yellow line. And make sure that neither of those lines are above the blue line or outside of the volatility band, okay? And then you buy on the candle close when the green line is above the yellow line. All right, those are the entry rules. Management rules, you can do stop loss a couple of different ways. You can either put the stop loss below the swing low, but I kind of like the idea of using the ATR for your stop loss, and I'll talk about that a little bit more. Okay. Then take your profit when both the red line and the green line cross above the 70 level. Again, I'm in favor of using the ATR to get the first half of the trade off. But again, I'll talk about that as we go through the details. Okay. Oh, I'm going to have trouble with all these images. I'm sorry, guys. I'm not sure what's going on here, but we'll get through this. Okay. So rule number one, you watch for the red line to break above the yellow line. So the yellow line, of course, is the center line between the volatility bands. And so the first sign is for the red to cross above it. Again, we're looking for a long trade. Next thing we're looking for is for the green line to break above the yellow line. Okay, so we found the red line breaking across. Now we're looking for the green line to break across. Now, at the time that the green line breaks across, you need to make sure that the red line is still inside the band. Okay, it's hard to tell sometimes, but drop a line, a vertical line on this, and then zoom in and make sure that the red line is still inside the blue band. And I'll show you that live, on a live chart shortly. Okay. So the next thing to look for is the green line breaking above the yellow line, and the red line is inside the band. All right. Here's an example. Bear with me. I'm going to keep having to do this apparently. Here's an example where the red line is outside of the band when the green line crosses. So the red line crossed right here. The green line crossed right here, but the red is already out. So this is wrong, wrong, wrong. Do not take this trade. The cool thing, to me, this is cool because you want to see positive uptrend movement without the movement, the price action exceeding the current volatility. That'd be like jumping in front of a fast moving freight train. That would be bad. Bad. Do not jump in front of fast moving freight trains. Okay. So this is an example of that. Don't do it. Don't get what I call FOMO. I didn't make that up. Somebody else did, but I like it. Fear of missing out. Don't get fear of missing out. Would you rather be in a trade wishing you were out or out of a trade wishing you were in? Well, I think if you jump in front of this, I think that you're going to wish that you were not in that trade. Okay. And once again, we'll load this image. You know, I don't normally use this many images. So this one time where all of this messes up would be the time that I've got a bunch of images, right? Okay. So once you see the green line cross, the red line is still inside, then you buy on the close of that candle. So you're buying right here on this close. All right. This is fun. You guys get to see how to use Google Docs or Google Slides at the same time as it's like double training, and you only get that here at Trading Strategy Guides. Okay, so the green line breaks, the blue line is still inside the band, the buy is here. One recommended stop loss is this swing low right here. Now, a lot of traders think in terms of hiding the stop below the swing low. And you know, there was a time when that sort of thing was a real valid thing, hoping that this support level, the level to which this candle dropped right here, will protect the stop loss. Okay. Um, the thing of it is, you know, the big banks know exactly where to find these, and if they decide that they want to take this out, they're going to take this out. Doesn't matter if there's a support level there or not. And so I'm inclined to just use a 1.5 times the ATR for my stop loss. The average true range. So I always have the ATR on my chart so I can see what the ATR is at that moment. And then 1.5 times that is my stop loss. And that's kind of a random spot. I mean, obviously, if I can calculate it and I make it clear that I'm using that as my stop, then somebody's going to be able to know exactly where my stop is. Uh, you know, you're not going to escape that. You put an order in the market, if you put a hard stop in there, then somebody's going to know where your stop is. You can't get away from that. But if your stop is not where a whole bunch of other people's stop is, then the big banks don't really have any incentive to come after your stop. Okay, so I just think sort of a random location is a safer spot than the place where, you know, 1,000 other traders are doing it. But as my kids say, you do you. Whatever makes you most comfortable is best. Just form a plan and stick to it. Just do the same thing always. Okay. And of course, make sure you test. You know, you need to test your strategies. You need to back test them, forward test them. Let's see. I think I'm on this one right here. The whole point of making these slides is so that I don't have to figure out which image I want to show you next. Okay, a suggested take profit is when the red and green lines exceed the 70 line on the indicator. Now, I'm going to show you the indicator live. On the indicator I chose does not default to 70, so I had to move those lines. I'll show you how to do all that stuff shortly. This works fine, except sometimes it doesn't actually get up here to the oversold spot. So again, I like to use the ATR, take half off my trade at the top, and then set the stop to break even, or break even plus 2 pips, or 20 cents, or, you know, whatever covers the cost of your trade, and then let the rest run. And if you want to let it run and then close the second half out when it crosses the 70, that's cool. But at least you're trade is free from that point. Okay, you made a little bit of profit and the rest of your trade is free. Once again, you do you. These are all just suggestions as to how to manage your trade. And I only make these suggestions so you have some idea of what's possible. You really need to do your own testing to find out what works for you, what works best in the situations that you like to trade. Okay. Now I'm going to show you one more image here. And I picked up these images from the blog, and I'll link the blog below. And I didn't write the blog, and 99% of the time it's perfect. But this example right here is kind of an oops, because they showed the crossover the red line here, crossover the green line here, but the red line is below the blue. So this would actually have been a no trade. Okay. Of course, this is the way it would have worked out if it had been an actual trade, but the red line had already crossed outside of the band. So sometimes you'll take a no trade. I mean, you'll skip a trade because it doesn't meet your criteria, and it'll do exactly this, and you'll go, well, you know, that was nice, but I missed it, and that's okay. There will always be another trade. Okay, so you cannot sweat this kind of thing, because you may take one that doesn't work, that stops you out, and then the next one that you pass on because it doesn't meet all your criteria, you know, turns out to be a big move. That happens sometimes. You didn't make a mistake. You didn't get the strategy wrong. The point is, no one knows exactly where the market is going or what the market is going to do. So so what you do is you look for an edge, something that works more times than not, and then you trade that and manage that properly so that you can be profitable. But you have to know that sometimes it doesn't work, and that's just the way it is, and that's okay. Okay, so let's look at a live example here. If I can find my charts again, here we go. Yeah, you guessed it, CAD yen. Anybody who watches me knows that I like to look at the CAD yen and the pound yen. I don't know why, they just feel good to me. Okay. I picked these off this live chart this morning. All right. So I try to make these examples as up to date as possible. And so this is an hourly chart from this morning. You can see this is the current bar right here. All right. And this is actually a live chart. So here's the first example. And I'm using examples with the stop losses that I would use. Okay. The first example may or may not have actually worked out. The stop loss, in this case, the ATR here was about 7. So my stop loss was 10.5 pips, which is just over the minimum. I recommend a 10 pip minimum stop loss no matter what. So so this is a 10 pip stop loss, and it came very close. Depending on the spread, you know, you might have gotten stopped out here. Sometimes a briefly expanding spread will grab your trade and stop you out when the chart, you know, if you look at the chart historically, you can't even see why you were stopped out because price never got there. But if your broker expands the spread to 5 pips for just a few seconds, bam, you're out. Don't ask me why they do that. You know, some people say, well, they're, you know, intending to take out stops. I don't know. But, you know, brokers are brokers and you got to deal with them. So, you know, whining about it's not going to change anything. But anyway, if I didn't get stopped out down here, then I hit my profit here. And then the second half would have gotten stopped out here because I would have set my second half stop to break even. So this either was a full stop or it was a half position, no big deal. Here's an example of a no trade, because when the green line crossed, the very next bar, the red line was below the band. So that would have been no trade right there on that one. But on the cross back over, here's the green line cross. The red line obviously is well inside the band. So the buy would have been on the close of this candle, which is the bottom of the bearish candle. The buy would be right here. The ATR at that time was 14 pips. So this would have been a 20 pips, 21 pip stop. And here's the 14 pip take first target right here. Second half probably stopped out right here. So this was clearly a half profit situation and a closeout. All right. Here's one that I found while I was looking for this. This candle had just opened when I was doing this. So this was a nice crossover and a buy right on the close of this candle right here. And currently it's about break even. So that one will just have to play out. You guys can watch that to see what this does. The ATR here was 12 and a half pips. So the stop loss would be about 18 pips down here. And the target will be 12 or 12 and a half. Okay, and one last chart to look at, pound yen. Here's the first one. This would have been a no trade because when the green line crossed over the center, the red was way out here. And that's what I really like about this. You see this really fast moving average right here is pushing up really hard because of these huge candles. So we've got all this momentum right here. And you know, after you get that much momentum for a little while, you're going to get what a friend of mine, pardon me for saying this, but what a friend of mine calls a puke out bar. A puke out bar is just a huge candle that just exhausts all the momentum. And that kind of happened right here. So it pushed up, it pulled way back, and it didn't really get above that candle, and then it dropped like a rock. So if you get these huge candles like this, that means your faster moving average is going to move outside of the volatility, and that volatility is not going to catch up for a few candles. So so it's going to keep you out of trades where the momentum is going to be exhausted early like this. That's what I kind of like about this. So that was a no trade, and this one though is a short trade, a sell. The green candle, the green bar crossed right here. The next close was this red candle right here, so it was a sell from right here. Stop loss was up here, was not hit, and it appears that the target would have been hit over here, and we would still be 190-ish pips up right here on the second half. So pound yen moves big like this. Pound New Zealand, Euro New Zealand. I like trading those things because you get lots of big moves. Okay. That's the story of the Traders Dynamic Index. I like this strategy on Forex pairs, on the shorter intraday time frames, but always experiment. My voice just quit working right there. Always experiment with other instruments and time frames. There's no telling how well this could work other places. Okay, you guys have any questions about, let's see, can you just wait for a red bounce off the green? Bill, I'm not sure exactly what you mean, and maybe I'm taking the question out of context. If you could clarify that a little bit, I'd be glad to answer that. I'm sorry, I don't look at the chat until after I've done, you know, going through the rules and the examples and stuff. So I don't mind you posting the questions, but sometimes they end up out of context then, you know. So anybody else have any questions that I can answer? Let me go back and see if I can figure out what we were looking at when you asked the question. Sorry, Bill. Go ahead and ask your question again, though. I'll be glad to answer it. And if I don't get to it while we're doing this live, you can post the question below the video when it gets posted, and I'll be glad. Okay. See, it was on earlier chart when the green crossed the yellow, no trade. Then the red came back up and bounced. Was that on this one right here? Let's see. This green crossed here. The red was out. Oh, I see. You're talking about like this pop up right here. I, to me, if I understand your question properly. Oh, it was on one of the slides. Okay. Hopefully my slides will work. Maybe it was on this one. Let's see. Oh, you're talking about like right in here? Here's and this is exactly what I was going to say earlier. Okay. I see exactly what you're saying because it's pulled back and it's no longer but you know, to me the signal happened and the signal happened after price had the momentum had pushed price way down, pushed the red out of the volatility band, which kind of suggests to me that the momentum that pushed the green line across has expended itself already. And that's the reason why I don't think. Now, you know, you could probably find examples where that would work, but and really what you need to do is back test things like that, you know, because you know that possibly could be a modification of the strategy that would make it even more profitable, okay, or get you into additional trades good trades that you wouldn't have been in anyway. Because this is a sad situation here to not have a valid signal and have it move like this. But if you look at it while this is forming, you're not seeing. Whoops. You're not seeing this move here. All you're seeing is this activity right here and this huge push down and this huge jump outside of the volatility. And my first thought would be, well, you know, this move is done right now. If I were looking at this live and didn't see all this here. So yeah, I'm thinking that this is something you might want to look at and back test, and basically just look back through your charts and find situations where the green line crossed, but the red line was outside of the band. Did the red line come back in and touch the green line again? And if it did, you know, inside the band, is it possible that that was a good valid trade after that? So I hope that answers your question. If not, don't hesitate to speak up. There's my cool question and answer slide. Yeah, I like Google Slides, but sometimes it's annoying. And mostly because it's live online, and sometimes my internet connection gets really slack around here. So you know, I probably should just use Microsoft Office or something to do these, but there you go. I've gotten hooked on Google Documents, Google Docs, Google Drive. And that's not a sales pitch. Anybody else have any questions, trading related questions? You know, don't ask me what's the meaning life, because I'd probably just say 42. And some of you might get that. Mudiaga, I hope I pronounced that right. Oh, Mudiaga, you know, normally I would figure that out because I use MT4 all the time. I will, if it's not a default indicator on MT4, I will find one and post a link to it below the video when we get done here. Okay. One place I like to go a lot to find indicators for MT4 is MQL5.com. MQL5.com. And that's the MT, well, that's the MetaTrader code base, basically. There are thousands of MT4 and MT5 indicators at MQL5.com. It is a gold mine. Now, if you just Google MT4 indicators, you'll find a lot of more gold mines. But MQL5.com is the biggest gold mine, in my opinion. So, and I, you know, I write indicators. I'm a programmer, and I write indicators and EAs all the time. One of the things about MQL5 is many of those indicators include source code, so I can tweak and modify my indicators to my content. Oh, one thing I forgot to show you is the details on this indicator. There are several TDI indicators in TradingView. I look. You can just search TDI like so. The one I chose was this one, Tuan Lewis Traders Dynamic Index. The one that's in the blog, I think, might be this first one right here, but I couldn't get the colors to match up, and I wanted to make sure the colors matched with the images I was using from the blog. So I took Traders Dynamic, this Tuan Lewis TDI, the one with 535 likes, and I tweaked it thusly. You select the settings button. I changed the colors to match the indicator or the images. Okay, and then on the inputs, I used all the default inputs here. Okay, so the fast moving average is 2 and the slow moving average is 7. The red and the green lines. The RSI is 13, and that's the yellow line. So that's the defaults I used. I expanded some of these lines out so they'd be, oh, and I changed the levels here. I think this level was 28 and this level was, no, this level was 68 and this level was 32. And I changed them to 30 and 70, and that draws these horizontal lines right here. And I removed the center line because we're not really using it for this strategy. Ozzy, is that candle range indicator? Yeah, I think I know what you're asking. This, the distance between these two blue lines right here is essentially equivalent to the average of the candle range, the length of the candles. Yeah, yeah. Let's see. Pleased with this video? Yes, yes, Jedi. This Jedi. That's great. I love that. This video will be available. I'm not sure exactly how quickly it posts after we get done with live, but it should be available at Trading Strategy Guides channel right away or very shortly after we get done with this live webinar, so you guys can go back and speed it up or slow it down or whatever makes you happy. We love it when you're happy. Anybody else have any questions? Well, if not, we'll just jump right into my favorite part and your favorite part, Tim's Trading Maxims. If you do have a question, go ahead and post it. I'll check again before we get done here. My maxim number 35. The markets can remain irrational longer than we can remain solvent. Now, I want to make it clear that most of these trading maxims I did not write myself. A couple of them I did, but most of them I did not write myself. This one is a classic, and I'm not sure exactly the source. I tried to find the source of this years ago. I've heard that it was Keynes, as in Keynesian economics, you know, the economics guy, or Schilling, who is also an old economics guy. I don't know. But in any case, this is the very reason we use stop losses. A stop loss is not to protect your trade. A stop loss is to protect your account. And that's our first job as a trader. Because if you don't have a trading account, you're not going to trade, right? So you don't want to be thinking, if I hold on to this trade a little bit more, the market will finally come back. Of course the market will come back. It always comes back. And I'm saying that, I'm not saying that ironically. I mean it. The market will always be back to where it is right now. Problem is, can you stay in the trade long enough to hold on to the market if it moves 10,000 pips away before it comes out? The point is, the market can stay away from your trade way longer than you can afford to hold that trade. Plus, you got your money tied up all that time and it's not doing anything. It's not helping you. All you're doing is sweating that trade, and you're sweating, you know, your account getting margined out and all those sort of things. And there are so many more lucrative trades you could have made instead of holding on that massively negative trade. So take your loss, get out, and then use that money to make money, make that loss back instead of holding and holding and holding. That's just crazy. And I'm speaking from experience here. I've done this, guys. All right. You know, the wise man learns from other people's mistake. Learn from my mistake. I have held on to trades and held on and held on and held on. And they quickly became trades that I wish that I was out of. So, yes, Ozzy, absolutely. Stick with the trend and you're unlikely to get and that's another hard earned lesson for me. I only rarely do reversal trades, and only with small stops. You know, when price is approaching a really strong support or resistance level, I might try a reversal, but I'm not going to hold on to that thing very long. But you get into a nice trend trade, and you know, you can take some profit on the trade, get your stop to break even, and then just let it ride and just, you know, enjoy the fruits of your labor. Okay. So here's a little summary of the strategy, but again with the images that won't load. Trust me, these images were loaded into this slideshow at one point. Let's see, which one am I trying to look at here? I think it's this one. Okay, remember, for the trade signal, you're looking for the red and the green lines crossing the yellow, and the red line not being outside of the bands. So if the red line's inside the bands and the red and the green are across the yellow, there's your trade signal. You buy on the close of that candle, and you're on your way to success. Even if that particular trade doesn't win, stick to this, and you're on your way to success. Okay. This is the purpose of testing, back testing, and so on. It gives you confidence that the strategy works and that it gives you confidence to take the strategy even after you've had a string of losses. Okay. Remember, if you've got a day job and you don't have time to analyze charts or trade or do all these things that some of us do, this should be helpful to you. Trading Strategy Guides has the Strike Trader Elite Trade Signals service. You get 4x trade signals on a dozen or so pairs on several different time frames, all based on the Strike Trader Elite system. I've used the Strike Trader Elite system, guys. It's pretty cool. Look below the video for a link to the free signals that come on the Telegraph application. And that's really cool too, because we used to use Skype to send out the signals, and we've used Discord, and we've used a lot of other things. Telegraph so far is absolutely the best way to get trade signals. So it's kind of cool. I'll also post a link below to the video here that explains the Strike Trader Elite system, as I talked about that several weeks ago. Tomas, hello. Okay, if you guys don't have any more questions, hit the thumbs up below if this helped you. Thanks for listening and subscribing. Don't forget to hit the bell for notifications when videos come out. Okay, if you guys have any questions after the live webinar is over, just don't hesitate to put them below the video. I will get to them as quickly as humanly possible. You guys have a great remainder for your week, and I will see you next time. Same bat time, same bat channel. Wow, I dated myself, didn't I? Hey, Bill, I used to, but not so much anymore. Getting in the zone for trading is hard for us old guys. You guys have a great remainder to your week, and I will see you next time.